This is Nightly Business Report with Tyler Matheson and Susie Gehring.
Falling short, two tech titans, IBM and Google, report disappointing revenues and their stocks trend lower after hours. What's the one key takeaway that investors need to know now?
Powering higher, China earnings and Federal Reserve Chair Janet Yellen fueling the rally as the Fed chief sends a clear message to Wall Street. Don't worry about interest rates.
And hip to be square, why utilities, usually a staid and slow-moving sector, are leading the way on Wall Street this year. All that and more tonight on Nightly Business Report for Wednesday, April 16th.
Good evening, everyone. We begin tonight with IBM and Google. They are two iconic tech companies, two big disappointments, and two stocks that carry a lot of weight, one on the Dow, the other on the NASDAQ. We start with IBM. Big Blue's quarterly report out after the market close was another in a long line of revenue misses. Income continued to be hurt by sharp declines in hardware sales. IBM earned $2.54 a share, right in line with predictions, but revenue missed, coming in at $22.5 billion. That was less than expected. That sent shares initially lower in after-hours trading. Morgan Brennan has been looking through the report and joins us now to tell us more about it. So, Morgan, as you look through the numbers, what do you see as the key takeaway from IBM?
Well, IBM is a big company with many numbers, but one of the biggest takeaways here is that China and other emerging markets have continued to weigh on IBM's growth. So countries like Brazil, Russia, India, and China, revenue has tumbled in those countries about 11% from a year ago, but none more so than China. So revenues in the world's second largest economy, actually fell about 20% from a year ago. That's as demand for servers and storage products continue to fall, also weighing on the hard-hit hardware division of the company. And IBM says that's not likely to let up anytime soon. Investors have been piling into the stock recently, favoring its perceived stability and dividend. But whether IBM makes a good investment will ultimately come down to the fundamentals in four key areas: services, software, hardware, and emerging markets. The services division is by far the biggest, accounting for 60% of revenues. But it faces a number of challenges, including competition from cloud storage, which helps other companies reduce the need for tech outsourcing. IBM's second largest division is software, a bright spot thanks to its core infrastructure software products, business analytics programs, and cloud computing offerings. The real trouble has been in hardware, a division that lost $500 million in 2013. Analysts expect similar losses this year and hope that trend can be reversed by 2015.
The transition period now is getting away from some of the more commoditized stuff like hardware to some of the more higher margin value add services like the cloud.
But there's one area that's been crucial to IBM: emerging markets. Countries like China have accounted for double-digit growth in recent years. But that changed in 2013 when slowing demand for equipment dragged on the company's overall revenues. Still, the company has been implementing changes, and it says that they expect to see those changes push towards better growth in the second half of this year. We'll have to see whether that takes place. Tyler?
Morgan Brennan, thank you very much. Now to Google, which reported earnings and revenues that both missed Wall Street estimates. The internet giant's profits per share came in at $6.27 after adjusting for accounting items. Analysts had expected $6.40. Revenue also a little bit light here, $15.4 billion, and that was enough to make investors edgy, shares falling initially after the report, as you see on that graphic there. Sheila Dharmarajan covers Google from the NASDAQ. Sheila, but beyond the upfront numbers, is there anything else beneath the surface that investors need to focus on in this report?
Yeah, Tyler, bottom line, the shift from PCs to mobile devices like your tablet or your smartphone just isn't as profitable for Google. So here's the issue. For now, Google can't charge as much for mobile ads as they do for ads on PCs. So even if the mobile volume advertising is growing, they're just not making as much money on it. Now, on top of that, you also have to add in the fact that Google gets charged every time it wants to be a default search engine on a phone. So the expenses are going up, pricing is coming down. Certainly not two trends you want to see go in those directions. Now, the Google's company did acknowledge some of these issues on the conference call, and they said they would be giving more transparency around the numbers Interestingly, they also said that in the long term, they do think that mobile pricing will be better than PC pricing. But of course, we're going to have to wait and see if that actually happens.
All right, Sheila Dharmarajan, thanks very much.
Janet Yellen delivered a strong message for investors today. In so many words, she said, stop panicking about interest rates. The Fed chief's reassuring speech in New York gave a big lift to stocks, and Tyler will have more on that in just a moment. Also boosting investor confidence, encouraging news about economic growth in China. So the Dow soared 162 points, the Nasdaq jumped 52, and the S&P added 19 points.
And more now about that speech by new Fed Chair Janet Yellen. In a major address to the Economic Club of New York, Yellen said that interest rates will stay extremely low for a, quote, considerable time. Yellen basically said the Fed is trying to thread the needle, that is, get inflation up closer to its target of 2% and get unemployment down closer to its target of full employment, that is, between 5.2 and 5.6%. That, she thinks, could take a couple of years and will require a generally accommodative monetary policy. Steve Leisman puts it all together for us.
Good evening. New Fed Chair Janet Yellen, in a major speech today before economists in New York, suggested it could take as long as 2 years before the economy meets the Federal Reserve's goals.
It's a sign of how far the economy has come that a return to full employment is, for the first time since the crisis, in the medium-term outlooks of many forecasters. It is a reminder of how far we have to go, that this long-awaited outcome is projected to be more than 2 years away.
The Fed sees full employment as between 5.2% and 5.6%. It's currently at 6.7%, and Yellen says that shortfall is significant enough that she suggested the Fed will keep trying to help the economy as long as the goal is not being met. Overall, Yellen made clear she was in no hurry to change the Fed's current policy of slowly winding down its bond purchases and keeping short-term interest rates low for an extended period. In fact, she's more worried about inflation being too low rather than too high.
With inflation running at around 1%, at this point, as I mentioned, I think the risk is greater that we should be worrying about inflation undershooting our goal and getting inflation back up to 2%.
Meanwhile, two Federal Reserve reports today suggested the economy is rebounding from the effects of the harsh winter weather. The Fed's Beige Book, a collection of economic anecdotes from the Fed's 12 districts, said consumer spending and manufacturing had both picked up as severe weather has receded. The Fed's report on industrial production in March came in well above Wall Street estimates, and February was revised higher as well. Only housing data disappointed, but not by very much. So the economic data continues to support the idea of a spring snapback, and the Fed chair suggests she's in no rush to raise rates and slow the economy down. For Nightly Business Report, I'm Steve Leisman.
Nariman Baravish joins us now with his analysis of the Fed and the economy. He's chief economist at IHS. So, Nariman, I thought that in her speech, in Janet Yellen's speech, that the best part actually was in the Q&A where she was pinned down about, is she going to fall behind the curve? Is she going to control inflation? And she seemed to give some very comforting answer that, no, the Fed's going to do the right thing when it comes to raising interest rates at the right time. What was your take on that? And did you find it reassuring or still worrisome?
No, I think it was very reassuring, and I think she got the message right this time compared with a month ago when she was speaking perhaps a little on an impromptu basis and spooked the markets. But this time around, clearly, she was on message, and I think she was very clear. She was upbeat about the economy, and yet she was dovish on monetary policy, essentially saying, as you said, we're in no hurry to raise rates, and that's the right policy at this point. We're still a ways away, as she said, from full employment. And so until we get there, and until inflation shows signs of life, which it hasn't, no reason to raise rates.
I was curious as I listened to her today, and she said we're probably 2 years away from full employment, which suggests an accommodative monetary policy until then. How did we get from 6 months from the end of QE to 2 years in 1 month's time?
Yeah, I agree with you. I think I'm not quite sure what was on her mind when she said that. Maybe she kind of felt trapped or something, or she just clearly misspoke. But I think our view is that the earliest the Fed's going to raise rates, QE we think will be over by the end of this year. But in terms of raising rates, our view is the earliest is probably mid-2015, and that's very consistent with what she said today.
And so what is your take on how the economy is doing, your own views and also what she was saying? Yellen was talking a lot about the job market. She seemed very upbeat that things are moving in the right direction. Is that how you see it? And just generally, what's your view on the economy?
Well, first things first, the first quarter was badly affected by the weather. And when we get the first GDP numbers for the first quarter, which will be at the end of this month, it'll show a very weak quarter, less than 1%. We think 0.9%. But that misreads the economy because the underlying growth rate is more like 2.5% to 3%, which I think is sort of consistent with what she's saying. And we're actually seeing that coming back in the second quarter. You mentioned the industrial, or Steve mentioned the industrial production numbers, the beige book. We've had the employment numbers starting to look better. So I think the answer is fairly clear. Bad weather hurt the first quarter. But by the second quarter, we're back to that sort of underlying growth of about 2.5%.
We're going to talk a little bit more about China's growth in just a moment. But if you broaden out your prism from the U.S. economy, how do you see the global economy right now?
Well, ironically, it's the developed economies, the advanced economies, that are doing better than the emerging world. They're actually contributing to growth. You've got the U.S. picking up this year, Europe going from a negative to a positive this year, Japan doing okay, whereas a lot of the emerging markets, growth has fallen quite a bit in the last few years and probably will continue to disappoint this year. Brazil less than 2%. Russia probably in recession. India, okay, doing a little bit better, but maybe half the growth rate of 2 or 3 years ago. So very disappointing.
All right. Nariman, thanks as always for giving us such good analysis. We appreciate it. Nariman Baravish with IHS.
More now on that economic data from China. It showed that growth in the nation's second largest economy dropped to its slowest pace in 18 months in the first quarter, but the figures were a tick above forecasts and seen as evidence that the government might stimulate the economy soon. With the details, here's Eunice Yoon.
In its first quarter, China's economy grew at its slowest pace in a year and a half. GDP growth came in at 7.4% from a year ago, beating consensus, and coming close to where the Chinese leadership wants the economy to grow for the year at about 7.5%. Now, most economists believe that the better than expected numbers mean that the government won't feel the need to stimulate the economy, at least in the short term. The authorities here have indicated that they're willing to tolerate slower growth and that the jobs picture will be key to their decisions to support the economy further. The latest figures show that wage growth and employment are holding up. Exports and the property market, though, were weaker. As for other data, retail sales and industrial production recovered slightly, but fixed asset investment did slip, further splitting economists about where China's economy heads from here. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Still ahead, the Camry has been the best-selling car in America for the past 12 years. So why is Toyota giving it an extreme makeover? We head to the New York Auto Show next.
General Motors wants a U.S. court in Texas to bar ignition switch recall-related lawsuits for now until a bankruptcy court clarifies whether the claims violate GM's 2009 bankruptcy. The automaker previously filed a similar motion in California. Kenneth Feinberg, who is advising GM on these claims, said that the company is likely moving to develop a program to compensate victims.
I'm assuming, and it's early, I'm just assuming that based on initial conversations with the company, that they're asking for me to help develop some sort of program that might be used to compensate eligible claimants. Now, who's eligible, whether there'll be a fund, how much money, what is the definition of how you're going to calculate the damages, or what proof will be required, all remains to be seen.
Feinberg said it may still be several weeks before he has a sense of how the fund will be structured.
Now, even though those faulty ignition switches have been getting lots of attention, General Motors is also looking forward. It's exhibiting its newest models along with the world's other automakers at the New York Auto Show. Phil LeBeau has been at the show kicking the tires and has the latest.
Here at the New York Auto Show, three of the most well-known names in the industry are getting plenty of attention, starting with this car right here, the all-new Toyota Camry. Toyota has changed virtually everything about the Camry to pump new life into the sedan. Camry has been the best-selling car in the U.S. for the last 12 years, but sales this year are lagging the industry as a whole. So Toyota has given the Camry a slightly more aggressive look and a more refined interior in hopes of keeping the car on top. Speaking of being on top, look what's on the observation deck of the Empire State Building. It's the 50th anniversary limited edition Mustang. Ford is selling 1,964 copies of the car to commemorate the fact it was unveiled in 1964 here in New York. And getting the Mustang on top of the Empire State Building was a Herculean task.
We literally had about 5 hours to bring the vehicle up in the elevators, and the team had 5 hours to put it back together again. They had to deal with the rain, the sleet, the wind, and 7 a.m. this morning looked terrific.
Finally, take a look at the first Alfa Romeo to be sold in the U.S. since the early 1990s. It's the sleek and sporty 4C, which goes on sale in June, starting at just over $55,000. Even though Alfa Romeo's comeback has been a hot topic in the auto industry, its presence here at the New York Auto Show has been understated. No press conference, no big dog and pony show, just the 4C, letting everyone know Alfa Romeo is back in the U.S. Phil LeBeau, Nightly Business Report, New York.
A sweet ride. American Express saw its first quarter profit rise as credit card customers spent more money, and that's where we begin tonight's market focus. The world's biggest credit card issuer said that although consumers are cautious about taking on more debt, loan balances have been modestly increasing. Revenue came in a little lighter than expected, but rose from last year. Shares down initially after hours. The stock ended the regular session, though, up 1.5% at $87.40. $6 billion in illegal charges weighed on Bank of America's first quarter earnings. The hefty fee is related to the bank's mortgage settlement with regulators stemming from the 2008 financial crisis. The nation's second largest lender by assets did manage to top earnings expectations after you take out special accounting items. Separately, there are reports that the bank is in talks with the Department of Justice to resolve a probe into Merrill Lynch's sale of flawed mortgage securities. Shares of B of A tumbled more than 1.5% in trading today to close at $16.13. And reports that SodaStream is in early talks to sell up to a 16% stake to a large investor sent shares way up in today's session. PepsiCo, Dr. Pepper, Snapple, and Starbucks all mentioned in the report as potential suitors for the at-home soda maker. Shares popped 8% to $40.75.
Shares of Gap rose on news it plans to triple sales in China over the next 3 years, making that Asian nation its second largest market. Gap opened its first Old Navy store in China earlier this year. The plans were announced at the retailer's annual investor meeting that was held today. Shares closed at $39. That was a gain of more than 1.5%. And United Health was the worst performing Dow component today after a downgrade from Citi. The insurer is set to report earnings tomorrow, and Citi's analyst says he expects strong first quarter results, but limited opportunities for earnings growth this year. The firm lowered its rating to neutral from buy. Shares fell more than 1.5% to $78.19.
And the utility sector, usually so sleepy, is up 11% so far this year. But is there still more room to run? And should you own utilities in your portfolio? Joining us now is James Key. He's president of South Texas Money Management. Mr. Key, utilities at, I think, all-time highs earlier today, certainly multi-year highs. Is their run, the best part of it, behind them? Can they keep moving up?
Well, you know, I think the right way to look at valuation on utilities is probably their dividend yield compared with other alternatives like 10-year treasuries. You know, utilities are kind of a bond-like stock. But the way to think about it, I think it's instructive to look at, you know, they were the strongest sector this first quarter, and who thought that at the beginning? You know, probably nobody. You know, at our firm, at South Texas Money Management, our view is these momentum stocks like the biotechs we saw recently and utilities are forever trading off alternating places. rather than trying to outsmart the market by getting in and out and trying to figure out when they're over or undervalued, our view is to take advantage of the natural diversification and own both. Always own some utilities. Always own some of all sector in your portfolio. And this is a great example of why that works. We tilted a little bit more into utilities after the first month when we started to see some of the momentum stocks shift.
But Jim, let me pick up on what you just said. You said it's like utilities are like a bond-like stock. And, we hear from so many other market strategists, rotate out of bonds, given that all the uncertainty about where interest rates are going. So how do you know as an investor whether you should be in these utilities, or is it time to, slowly get out of them now that the economy is picking up a bit?
Well, you're still going to want to own bonds. Even with rising interest rates, it's important to have, we think, own individual bonds, pretty short maturities, so you can, in a ladder, so you can reinvest as those rates rise. But utilities are going to dampen the equity part of your portfolio. They're very defensive. They're very low volatility. So within stocks, utilities are automatically going to offset some of the declines in some of the higher beta stocks, some of the momentum and growth stocks.
All right, so let's name some names here. I gather, though, that you are a believer that the best way to get into utilities is through ETFs. Why and which one?
That's right. We usually like individual stocks, but the utility sector is very unique in that it's very regulated. The returns are basically held to the cost of capital, the ROI. So there's not that much difference in corporate performance. So it doesn't really reward putting a lot of time into company analysis and security selection. So we argue, own the group, buy a low-cost ETF. We use State Street's Spider UTX, but it's important to just make sure you have a place in your portfolio, a weighting of utilities at least consistent with the market's weightings at all times. Right now, utilities are about 3.5% of the market.
All right.
All right, James, thank you very much. We appreciate that.
Sure.
James Key with South Texas Money Management from San Antonio tonight. All right, coming up, it is college acceptance season, and tuition bills for the fall semester, I should say, will soon be in the mail. Get ready. How can you make paying the bills less painful? We'll take you through it step by step.
The New York Attorney General has reportedly subpoenaed a half dozen high-frequency trading firms. This is according to Dow Jones. Eric Schneiderman is investigating whether some firms have an unfair advantage over others and is looking to see whether there are any secret arrangements with exchanges that may give them the ability to trade ahead of others.
Millions of college-bound high school seniors are receiving, if they haven't already, college acceptance letters and financial aid packages this month. But as families talk about which school to choose, relatively fewer of them have actually talked to their kids about how they're going to pay for this big nut. Sharon Epperson has some strategies to make paying the bills a little less painful.
Many students may have already decided where they want to go to college this fall. Meanwhile, their parents are still figuring out how they'll pay for it. Many parents seem to be overwhelmed by the cost of college, which has ballooned since they were undergrads. A Sallie Mae study found families spent an average of $21,178 on college costs last year. But there's no need to panic, financial advisors say. Keep this in mind.
It doesn't mean you have to do the whole thing. There are various funding options for college.
Most families pay for nearly a third of college costs with free money, scholarships and grants, according to a Sallie Mae survey. 27% of the total college tab is covered by student and parents' loans. And the same percentage comes from parents' income and savings. A plain vanilla savings account is often their top choice, but 529 plans offer more tax savings.
529 accounts are built to give people tax benefits and saving for college, and people who aren't using them are missing out on those tax benefits and potentially having less money for college when it comes time to pay for that.
With 529 plans, funds can be withdrawn tax-free to pay for qualified education expenses, including tuition and fees, room and board, book supplies, and equipment. But how much should parents withdraw from 529 plans each year?
My advice in general is to take your money out as quickly as you can, as long as you're sure it's going to be tax-free, because that way you lock in your tax-free gains in that account. Even if you decide to turn around and put more money in the account, I think that's your best strategy.
Some parents may be eligible for the American Opportunity Tax Credit, too, for tuition expenses of up to $4,000. This creates a tax credit of up to $2,500. To be strategic, families may want to wait to withdraw funds from a 529 plan to take advantage of these tax savings.
They should not be taking that $4,000 from their 529 plan. They should be taking that from other sources, out of pocket or loans, because you cannot double dip. You cannot take that tax credit and take tax-free distributions from your 529 plan for those same expenses.
Many families may also need to turn to loans to pay for at least a portion of the college bill. If your child qualifies for the federal Stafford loan, Hurley says that's a good deal, with 0% interest while in college and a very low interest rate after graduation. For Nightly Business Report, I'm Sharon Epperson.
And they better major in something that they can get a good job afterwards to pay off.
To pay back some of those loans, exactly.
That's Nightly Business Report for us tonight. I'm Susie Garrett. Thanks for joining us.
And I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody. And we'll hope to see you right back here tomorrow night.
I'm Susie Garrett with a Nightly Business Report news brief. On Wall Street today, stocks rallied thanks to reassuring words from Janet Yellen. The Federal Reserve Chair said interest rates will stay low at extremely low levels for a, quote, considerable time. On Wall Street, the Dow soared 162 points, the Nasdaq jumped 52, and the S&P added 19 points. After the market closed, two iconic tech companies, IBM and Google, disappointed investors when they reported quarterly revenues lower than expected. Their stocks initially traded lower. General Motors wants a U.S. court in Texas to freeze ignition switch recall-related lawsuits for now until a bankruptcy court clarifies whether the claims violate GM's 2009 bankruptcy. And the New York Attorney General has reportedly subpoenaed a half-dozen high-frequency trading firms. Be sure to tune in to Nightly Business Report right here on your public television station.